whether it physically is or not, but transactionally within the system now, and then you issue that back up to a higher level, a parent, then what happens to all that cost? Oftentimes, you lose visibility. It just becomes a lump of inventory cost up at that level, and then exacerbate that if it goes many levels above that. So now you're at the top level looking down, trying to figure out what your actual labor cost is on all these, and all you have is these lumps of material costs down the path.
Growing a business requires a holistic approach that extends beyond sales and marketing. This approach needs alignment among people, processes, and technologies. So if you're a business owner, operations, or finance leader looking to learn growth strategies from your peers and competitors, you're tuned into the right podcast. Welcome to the WBS Podcast, where scalable growth using business systems is our number one priority. Now, here is your host, Sam Gupta.
Hey everyone, welcome back to another episode of the WBS Podcast. I'm Sam Gupta, your host and principal consultant at the independent ERP and digital transformation consulting firm Elevate IQ. Most people understand why unit economics is critical, as that drives profit margins. They might use different names for it. Some might call it cost accounting. Depending upon the industry, different terms may be used. But the intent is very similar: to understand the cost to produce a product. Cost accounting is also a unique profession, as it sits at the intersection of finance and operations. You need to understand the depth of both worlds to be effective as a cost accountant. So which are the KPIs that are critical for cost accountants? In today's episode, we invited a panel of cross-functional experts for a live interview on LinkedIn who brings significant expertise to discuss the top KPIs for cost accountants. We discussed the maturity of cost accounting in different organizations and how that might impact KPIs that cost accountants might track. We also discussed different challenges such as currency fluctuations, regulatory requirements like market pricing used for regulatory reporting, and how overhead allocation might impact the cost accounting KPIs. With that, let's get to the conversation. Hello, everyone. Welcome to today's show. And if you are joining for the first time, this is part of our digital transformation series, for which we meet every Thursday at 5 Eastern. We pick one topic related to digital transformation. For this year, we have a lot of different KPIs topic, and for today, we are talking about KPIs for cost accounting. And cost accounting in general has been a very religious topic on this podcast, so I think we are going to have a lot of fun today. So before we dig into the topic, we are going to start with everybody's intros. I am going to start with my intro. If you don't know me, Sam Gupta, principal at Elevate IQ. Elevate IQ is the independent ERP and digital transformation consulting firm. On that note, I am going to Chris for his intro.
Thanks, Sam. Chris Giardini, the owner and president of Turnkey Technologies, 29 years as a Microsoft Dynamics partner, and said look forward to the topic. Thanks for having me.
Amazing. Thank you so much for being here, Chris. Abu, can I ask you to introduce yourself next?
Thanks, Sam. My name is Abu Asif. I'm president and founder at Penny. We are a Sage X3 partner for the last 12 years. Glad to be here.
Amazing. Thank you so much for being here, Abu. Mark, can I ask you to introduce yourself next?
Good afternoon. My name is Mark Lilly, President and CEO of LillyWorks. We help manufacturers solve the late problem with tools that tie into your existing ERP for managing production or the entire ERP. You don't have one. So looking forward to the cost accounting.
Okay, amazing. Thank you so much for being here, Mark. Sharon, can I ask you to introduce yourself next?
I'm glad to be here. Thank you, Sam. My name is Sharon Custer. I am an independent inventory optimization consultant. You can find me at the inventoryoptimization.pro. And I help e-commerce to increase their cash flow profitability by managing and optimize their inventory.
Amazing. Thank you so much for being here, Sharon. And today we are going to optimize the cost accountants a little bit, okay? we are going to identify the right KPIs. Okay, if you're in the audience and joining for the first time, make sure you guys post your questions and comments. We typically try to cover them during the show. If we run out of time, we'll make sure that you guys receive your answers. On that note, I am going to start with the first question with Chris. And Chris, my favorite topic always is going to be with respect to the evolution of the company. I don't know when companies realize they need to do anything close to cost accounting, because if you talk to any of these startups, I don't know if they have really figured out their SKUs and bombs. If you are going to be, let's say, in the manufacturing distribution space, your life is going to be slightly easier. But if you talk about any other industries, sometimes companies don't even know what are their SKUs and bombs. And if that is going to be the case, how do you sort of account for the cost? That is number one. Number two, sometimes companies sort of know that they kind of know their cost, but they don't know how to account for it. So that is always very interesting conversation. But when it comes to KPIs, and they might feel that they sort of have the hang of the KPIs, but they might not know, if they don't even understanding how cost accounting is supposed to work. So Chris, over to you. If you could talk about the role of the cost accountant in general, set the context a little bit, overall from the KPI perspective, and what are going to be the top KPIs. Chris, over to you.
It's a great topic. And I think your point is valid, is based on the size and the maturity of the organization. They may not have a full-time person in that role, but don't be confused. Everybody is doing some of the basic analysis for cost components. And if you think about, in a production setting, and again, at that setting where, okay, it's my job, I'm the cost accountant. And, what am I looking at if I'm monitoring operational execution and for flags and KPIs, and I like to look at variance. And so variance is a great word, because I can look at variance on everything if I've set standards or targets or forecasts. So I've used a few different words there that all play all over the place. What's my variance on production output? Oh, I used to make 10 widgets a day. I make 3. Well, that would concern me as a cost accountant if I have production variance. Even workers. I doodle on the worker because of how, the world has changed with workers. And you go back to, if you're a cost accountant, again, how are you measuring your effectiveness of workers and efficiency on workers? Because not all workers are created the same. Machines are going to be different. Hey, this one makes 50 widgets an hour. This one makes 51. Okay, we're all right with those 2 machines. The guy that's making 20, we're getting rid of that one. But we go back to people. But the analysis of some of those things, for example, is we're just looking at trends. But again, we're establishing what are the baselines. And so if I talk about variance to cost, right, and we think at a macro, let's start with just purchased materials. In a standard cost setting, you're establishing a standard cost for material, even though the vendor may move. And the reason that you do that on a standard cost of a material is you can assign more than just the material cost. You can assign some fixed and variable overhead in standard costing world. What that means is now you're including the material storage cost, for example, with the price of that product in the standard cost. But again, I'm looking for variance, right? Well, hey, my assumptions, what happened? It's up. Cost went up. Well, that's a flag. Did my price doesn't necessarily automatically move if my cost moves. Another related one is you're just looking at gross profits, and you're looking, okay, then maybe there's a baseline. We're at 17.35%. That's the target. Hey, we went up. That's good. Hey, we went down. We've got another problem. So whether they're a macro indicator or it's a micro indicator on a cost variance, right, or a profit variance, which is indicating I've got more cost. And we talk about material. So it could be labor related. Okay, we go back to, all right, and again, depending on the organization, not everybody clocks labor, right? So how are they tracking? How accurate is my labor consumption in manufacturing? You're looking at wages, shop wages, and they look at how much of it do I consume in manufacturing, and what's the variance again? What was that standard labor? How much labor am I using? Is it taking more labor to produce the same products? And again, the guys on the floor aren't paying attention to that. They're just making widgets. They don't know that it's taking me 2 more minutes per product to make it. And oh, by the way, my defect rate is up. So I'm going to throw that one in there too. So again, just a number high level, I'm not going to take them all, but quality is another one, because as you look at, well, we're making the same number, but they're not as good. And again, that's worker, organizational, but just a few, because those really can impact the P&L substantially. More cost, less margin, quality, returns. Again, there's a lot of things that could start moving if we're not watching. I'll stop there.
Yeah, could not agree more. I think that's a great start overall. I really love the way you started with the variance, and that I'm actually going to hit on that a lot today, because that's really where there are a lot of problems overall from the cost accounting perspective. Now, one of the things that I like to touch on is standard costing always with this conversation. Okay. And when you talk about standard costing, traditionally and historically, if you really look at how standard costing started, the whole idea, at least, and you guys can tell me because obviously you guys have been in the business, Mark, especially Chris, far longer than I have been. So you can tell me if I'm off here. But my understanding was that the whole idea of standard costing was that, you know what, I am going to create these standard costs so that I'm going to make sales, marketing, manufacturing easy, and then smart accountants like Sharon can figure everything out, in the background related to cost, right? So we created this culture of variances, and I don't know whether even today finance professionals or CFOs they really understand when you are going to create these information silos, when you are going to create these ledgers there are going to be substantial number of variances. Even today, if you look at, especially in the small as well as the large space, mid is okay in my mind. Okay, the small and large space. What is going to happen is they are going to have a lot of different systems. Each of those systems are going to have different information that is going to be required for cost accounting. And if you don't have that connected, it's very, very, very hard to understand the cost. And because of that, all of your KPIs are going to be all over the place. And I don't even know if these companies really know their gross profit because, if you don't understand costing, you sort of know you have vague idea. You kind of don't know, to be honest, where you are. So, Chris, any other follow-up comments
Yeah,
you from?
and I think to your point about standard costing versus actual is maturity. And again, the complexities and what's the problem? Why do people want to go to standard? The variability. Oh, we're seeing too much variability, or they can't manage the processes and capture the data accurately to get a true unit cost. Well, I got too much labor on this one, not enough on this one, and then maybe it's just challenging processes because of the org. Again, maybe they're not. But again, what's the right answer for the organization? Maturity answers that. I'm not the one that says do standard actual. Typically, the clients are coming in and said we have to do this as actual. So maybe Mark will probably have.
Amazing. Thank you so much, Chris, for the commentary. Abu, I'm coming over to you. So from your perspective, what have you seen overall from the cost accounting perspective? Any KPIs that you have seen in working with?
Sure. I mean, I'll comment on the standard cost a little bit first. So, I mean, typically, standard cost is planned cost, right? And the advantage of using standard cost is you can, if there's a variance, then it forces you to investigate the variance right away, right? So you can
Yeah.
build that into your cycle. The other advantage of standard cost is that you can revalue inventory, right? So especially in some sectors like agriculture where they want more market-based value of the inventory pricing rather than the actual inventory pricing, that becomes a lot easier to manage, right? Because you can, if you have inventory at $10, now you want to revalue it at $12, you boom, you can just do it in one step. Compared to perhaps lot-based pricing or any other pricing metrics, it becomes really more calculated, calculate each individual widget's price. So, but again, it does not work if you have too much variability, right? If you planned for one quarter and your raw material price, for example, steel can vary all over the map, right? It can be or oil price if it's, for example, it's a component, right? Then you're always trying to figure out, why is there a difference, right? So plus and minuses against both. It has fallen out of favor also a bit recently because IFRS wants you to report actual costs, right, when you're reporting inventory. So if your standard cost, then again, there's a whole cycle. You have to revalue inventory for each. From my perspective, the biggest issue in costing is how to allocate the overhead. It's each inventory, you have, for example, you have an engineering firm, you have design engineers who are designing multiple products, you have utility bills, depending on the industry, can be huge, cleaning services, so on, right? And you've often seen whatever allocation method you choose, you end up changing it afterwards because suddenly one product line does not seem as profitable. And that's your favorite product line, right? That cannot be profitable. And then you often find that people change that allocation method just to make their preferred product lines more profitable, right? So that's probably the biggest issue, I see in determining how to allocate it, and then trying to calculate those allocations, right? It can become very complex, right? It starts to add up all the factors, right? So you have utilities, rent, cleaning services, engineering design, accountants, and depending on industries, there can be 10 other factors. And then you have a senior engineer working on it, for example, or a junior engineer. Is the machine operator experience? What's the pay rate? So all of that becomes really complicated very quickly. And just to manage all of those numbers, then you need to justify it every few months to your calculation.
Yeah, so very interesting comments there, and I am going to touch on some of those, just to make sure that listeners are able to follow along, as well as, for personally for me as well. I think there are going to be some clarifications, and I always sense a little bit of disconnect overall in terms of how people sort of understand the purpose of standard costing in general. Okay,
Yeah.
so when you started your commentary, you started standard cost as the planned cost. That's my understanding as well.
Yeah.
You are budgeting a cost, you are proposing a cost, and this is going to be beneficial when you are going to have an environment where your costs are not going to vary as much, meaning you are not going to get as many variants. Okay,
Mhm.
if you are going to get too many variances, then you are increasing the accounting effort, right? So that's
Yeah.
what you mentioned. I think there was a little disconnect between you and Chris, so you guys can clarify that later on if you guys like. The other thing that you mentioned was the IFRS started asking to report based on the actual cost. So I don't know if you're going to have any more colors there. Overall, where that is applicable, are they mandating that companies report? And I know that there is a choice between whether you can choose IFRS or GAAP, depending upon which method that you want to report on. You don't have to always report in IFRS, but are they asking people to maintain this? And how are companies that are going to be on QuickBooks going to do actual costing? Because that's extremely difficult in my mind.
Yeah. What happens is, like, it is getting mandated. Especially if you are also if you have more international business, and especially if you have public reporting, right? That's where it becomes an issue. If you're not a public company, then it's not an issue. But yeah, if you're in QuickBooks, it's a problem, right? And what happens at the end of each period is, you have accountants trying to figure out the actual cost, and then creating all these journal entries, big Excel sheet of journal entries where they're doing, revaluing the inventory, reducing, and so on. So that's how, smaller, I mean, I would even say larger companies do that to an extent as well, because, tracking the original cost is hard. Things happen, mistakes happen, and then you have to figure those things out. Right? So yeah, so it ends up being a big Excel journal entry list that they have to do every report.
Yeah, amazing insights there. So I had one more question, Abu, for you. I didn't want to throw too many questions because you'll lose keep track of them, right? So the original comment related to the market-based pricing. Okay, so market-based pricing, when you look at the costing and pricing, these two are two different things, right?
Mhm.
And if you are using any sort of ERP systems, you should be able to determine your pricing based on a formula. So I don't know if you need to base your pricing or report based on market-based pricing. I'm not sure.
Yeah.
Yeah, go ahead, Abu.
In some industries, for example, like the cannabis, that's what they require you to do, especially around agriculture. So they will require you to report how much cannabis, what's the value of inventory based on the market-based price, rather than how much it actually costs you. So that's the value of your inventory. So depend on the industry. It does not happen that much in more traditional distribution or engineering firms, but in certain agriculture-based industries, that's that's what you have to report on, the value.
Interesting. And is that only for the finished good, or for the raw material? Because if you are going to use the market price for the raw material, and if you are going to be computing the cost based on that, then you don't have to sort of mandate your finished good to have the market-based pricing.
It's pays for the finished good, not the raw material, right? So for the finish. So for example, you're buying pesticide, that's a raw material in the agriculture industry, right? So you're not going to price it at the the market price. That's whatever you bought it for. But when you're producing the finished good, for example, corn or cannabis, for example, so that's the market-based inventory value that you're.
Very interesting. Thank you so much, Abu, for that. So, Mark, I'm coming over to you. Based on the commentary, whatever you want to share related to the cost accounting, I know that you are probably going to have a million layers uh, in the cost accounting. And if you are going to be keeping all of these cost layers in million different systems, good luck with your cost accounting.
Well, that's exactly the point, right? Is the more layers in terms of your bill of material structure, especially, right? The deeper and more complex the whole costing picture becomes. I mean, it just starts, and by the way, just let me start with the comment of standard versus actual. We don't, as you know, I typically service primarily manufacturing industry, and honestly, in North America now, many of our global customers do pretty much 90% are make to order, custom. They're not making widgets anymore, right? They're making custom product at some level, some very deeply custom. Some of them are, maybe a standard base product with custom on top of it, right? But at the end of the day, they're not doing standard costing, so it's almost a requirement. But it starts at something as simple as the inventory, right? I mean, you need something to support that visibility. We're talking about, QuickBooks, right? You need something that's gonna show you, and you'll be able to have visibility of the fact that you've got 10 of this raw material in stock that you paid this much for, and then you got another receipt that you got a discount on, that's only at another price, right? So you have to keep track, and then which of those costing layers went into which WIP products, right? That affects the cost of each of those products, whether it's a standard product or a custom product. Now add another product layer on top. Maybe that's a subassembly that's going into another product, okay? And then one of the challenges between subassemblies in particular is visibility of the cost components, right? So you have once material goes into WIP and you start applying labor and per ABU the overhead rates, however you're establishing those, right? So you've got material, you've got outside services if you send things out and back, you've got labor, you've got overhead components. Now once a subassembly is received back into inventory, whether it physically is or not, but transactionally within the system now, and then you issue that back up to a higher level, a parent, then what happens to all that cost, right? Oftentimes you lose visibility. It just becomes a lump of inventory cost up at that level. So, and then exacerbate that if it goes many levels above that. So now you're at the top level looking down, trying to figure out what your actual labor cost is on all these, and all you have is these lumps of material costs down the path. So it makes it very difficult to see your true costs at all levels. So those are the types of struggles we see. And then there's another bigger one around overhead, but I'll save that for after your question or my next.
So Mark, I mean, I definitely want to touch a little bit more on the companies that might not understand why this traceability is important. So you mentioned that, you definitely need to know which particular WIP is going to have which subassembly. I know that you are claiming that 90% of the companies are probably doing actual costing. I doubt that. Even if they are doing it, to be honest, okay,
right,
they might not be doing right. I guarantee this, because if you look at the 90% of the company, they are probably going to be on QuickBooks and Xero.
But but they're not like doing in their. If you looked at their books, though, they're not like booking standards and variances, right? They're booking an actual. Even in QuickBooks, I think most would say that. At least my market space. I mean, we're talking, $10 to $200 million manufacturing that area.
Interesting. And so describe the process, let's say, and I don't know what you have seen overall from the QuickBooks perspective. Let's say if you are going to be on QuickBooks, QuickBooks is not going to have as many inventory layers to be able to accomplish what you are looking for.
Right.
If you really want the visibility into each of the costing layer, QuickBooks does not have that.
Correct. Correct.
So that's going to be probably manual, Mark, right?
Yeah, no, they're moving off another system if they've grown to the point where it's making a difference and it matters.
Okay, very interesting. So maybe if you want to touch on the overhead comment as well, go ahead and provide whatever you wanted to say related to overhead.
So it gets back to unit cost, right, and the calculation of unit, right? So you're looking, maybe you're a manufacturer, you make a lot of different parts, and you get your list of parts, and you're analyzing what the cost of parts is, right? So you look at the material, you look at any outside service cost, you look at the labor that's going into it, okay? So the operation steps, how much time is in each operation, you sum that up. And then per Abu's point, you got everything else you're paying for, the lights, rent, whatever, you're cleaning, what have you, and overhead, right? And what folks do is, and there are a number of methods to do this, but they allocate this overhead and make that part of their parts. Is it a cost to them? Of course. It is cash they must pay, right, on a monthly or weekly basis. But they're allocating it, right, in several senses of the word, the literal sense of the word, to their unit costs. So it's a fairly random number. It's somewhat arbitrary, right? But they're making incredibly important decisions based upon this unit cost. Yeah. Like, should I even manufacture it inside anymore, right? And well, this is very expensive. Well, yeah, that's because you've allocated 400% of the labor cost as overhead. Yes, it looks very expensive. But there's another way to look at these that gives clarity in terms of that. So now they get to the point where they're calculating profitability by part, right, based on this unit cost. Price, that's easy to get. Just look at the sale, what you're selling it for. There's your price. And subtract this unit cost number. That's my profitability. Well, the fact is that it doesn't add up, right? The profit across all of the parts that you're going to make in a given time period, in a month, for example, doesn't equal your company's profit, right? So there's something is skewed somewhere. And at the end of the day, it's this allocation of, to some degree, labor, but mostly overhead into this unit cost and the decisions they're making with that. And it hasn't helped industry at all.
Yeah, could not agree more. Thank you so much for those insights, Mark. Sharon, I'm coming over to you. So in your experience, obviously you deal a lot more in the QuickBooks space in general. That's my understanding. If that is not correct, please let me know.
Yes.
When you are dealing in that space, obviously there are different nuances. Number one, obviously when you have to allocate your labor cost, the system needs to support that. Sometimes you are going to have different ACM system, different payroll system. Sure, you can probably identify your employee inside the system, but I don't know how accurate you are going to be overall in capturing the labor cost inside your system if it is not really designed for those costing layers. So what challenges do you see overall from the costing perspective? Any specific KPIs that you have seen in your experience that might help them understand the costing and the problems, I guess, especially in your space. So yeah, Sharon, over to you, whatever you want to share.
Okay. Well, short for the QuickBooks issue is that you can't really calculate or allocate the cost inside QuickBooks, not there. You have to use third-party app or Excel to calculate that to be able to analyze your, data. So in the nutshell, QuickBooks cannot do much for you in that department. Second is that I see that in e-commerce space that the cost of goods sold is kind of just lumped into a number and then do a month-end or year-end adjustment. So the problem comes is that you don't know if your inventory got broken or stolen or accuracy. It's just kind of a hidden problem there that nobody wants to see. So that's the issue. I mean, but it does affect, the business growth, especially that the invisible cash flow just draining out of the door or the back door. You don't know how much. So, but come back to my own observation. I think there's a lot of issues or a lot of ways or issues around, how to allocate cost, how to allocate, overhead that Abu and Mark was talking about. But in general, I want to come back with the vision. I would like to talk about the accountant not just focusing on how much they can save, $1 or $2 per unit, or how much the cost per unit is, things like that. I want them to think about not just the profit and loss, it's not just the profit margin, but in the long run about the opportunity cost and the cash flow. So that I want to bring up the concept of the accuracy of the forecast, sales revenue forecast, and the cost forecast. And also I want to echo what Chris just said. You got to look at your variance in the period of time, what happened, it's not just you have the baseline where you are from, but in between the up and down, and you have to see where you're going. you don't want to go down, you want to try to go up. So in between those time, you need to find the way of the improvement. Even, I know there's many ways to allocate your costs, and none of them may not be that accurate, but it will be better than you're not doing it at all. Yeah. And another point I want to talk about is importance of what you're tracking. If you feel the factor is so important to you, to your organization especially, then you need to look at how do I find a way to track it, instead of feeling it's so much trouble, I don't want to do anything about it. For e-commerce, if you do international, you may like your stuff that you're buying from overseas, you need to look at your exchange rate, impact your profitability or your sales volume, or something is like the pricing that you set to sell your product. All those things that it really depends how important that factor is to your organization, and you have to track it.
Yeah, so some great insights there. So I'm going to touch on, some of those, Sharon, and then probably you can offer some more follow-up commentary if you have. So here, I think Mark is lucky to be in the manufacturing space. To be honest, when you talk about e-commerce space, and it's always fascinating to understand, how these industries evolved over the period of time. And sometimes it becomes more of the industry trend just because everybody else is doing it. So I'm going to do it in general. Okay. In the e-commerce space, traditionally, they didn't have as much accounting maturity in general. Okay. Because the e-commerce space, companies were started by people who were either developers, programmers, had really good insight into digital, could create website, start business. That's how the whole e-commerce space started. Maybe some people probably sold and they hired a bunch of programmers and then they started creating this one. So their whole focus always have been on sales. Okay. Accounting is all back end. Okay. So they will talk about the unit economics, but they don't necessarily understand how unit economics is supposed to work. And in general, I have seen crazy scenarios, okay, in e-commerce. And Sharon, you can tell me if you can relate with this, okay? So we were talking to a bunch of customers in the e-commerce space, and I was like, okay, how do you reconcile your channels? Because typically in the e-commerce space, you are going to have many different channels. Each of them are hosting your inventory. So obviously you need to be able to reconcile what you have sold, and you were talking about this whole physical counting and cycle counting processes, right? They don't have all of that. Even like some of the companies that are going to be $20 million in revenue, they don't have all of that. Okay, and how do they reconcile? They are simply going to make a bunch of journal entries, and that's it. Inventory is sort of reconciled. It's, to be honest, I mean, it's funny for me because, ideally, if you are an inventory-centric organization, you should be reconciling every single channel. You should be tracking that. You should have the cycle counting process. So again, if you are going to do that, you won't necessarily have any sort of, at least the cost accounting related KPIs that are going to be closer to being accurate. So Sharon, over to you, whatever you might want to offer.
I think a lot of e-commerce, they relied on the third party to tell them how many units they have in the warehouse, or they don't even have the control over their own. They have to find a way to dispense in a small amount so they can reduce their risk of loss, or have a software really managing how many inventory in a certain place. In a way that they have to have a much more accurate idea where their stuff is and how many they have.
Yeah.
Oftentimes that is some of the things they go to a logistics center and they suppose third party to dispense their orders. They don't really physically count how many they receive or how many they go out. They rely on the third party to tell them. Sometimes the stuff just kind of lost in the truck or stuck in the back of the warehouse. I mean, like they have no idea. It's not like a big company, they have a tighter inventory control. The smaller e-commerce, they don't. They just kind of happy-go-lucky, and that's where the money goes. I lost the money. Yeah.
Amazing insight there. Thank you so much, Sharon. Chris, I'm coming over to you, and it's kind of, I'm pretty sure that you are probably going to get kick out of it, right? The whole reconciliation, and it's very critical for any business, because even if the third party is telling you that this is what I have in my inventory, you still have to match that. You have to check that. You should be able to verify, because Chris, you are a smart guy, right? If you kind of know that, if you're working with any of the vendors and they sort of don't have their game figured out, then you kind of know, what to do.
That's right.
You can make up any number and send it to them that this is what I have. Okay, good luck.
It's a accrual-based system. Just book an entry. Oh, it's gone tomorrow? Wait. Yeah. Yeah, it's interesting as you go back to compliance. And I was going to mention that I had a call today for a CAS compliance. What is that? CAS, Cost Accounting Standards Compliance. So who am I dealing with? Defense contractors that are selling upstream into the federal government. So civilian organizations, you can pretty much do whatever you want and get away with it, which is interesting to hear it said like that, because, Mark, you probably find people that they're costing, it's only material costing. Well, why are they doing that? Because the owner wants to expense the labor and the overhead and minimize his taxes. Okay. Right. But again, as you look at the cost accounting standards, and I was in this meeting today and pulled up the list, and there's this, I'll say, I got a chat log from these guys, but if you think about compliance, consistency in estimating, accumulating, and reporting costs, accounting for unallowable, use of standard costs for direct materials, accounting for compensated personal absences. So the granularity in cost accounting standards, we don't live in that world. But, as you came back to the overhead, and that's where I was going, is I don't put overhead in there. Well, why? Because they want to expense that. And it gets very interesting, because now we go back to accuracy and how do we price and how are we really calculating? And I wrote the word down, distortion. It's distorted. And you know what, right? Because, I plugged a number. And I think, the example even on, how do you determine how to allocate overhead to inventory, to the material? If you've got material and it's got a fixed and a variable overhead, what are your fixed? Warehouse? How do you take the total cost of the warehouse and allocate it down to a product? Do you do it by cube? Do you do it by weight? There are precise ways to come up with the formalization to allocate the warehouse, right? That's the electric, that's the building, the rent, the cleaning, that's the building. What else is going on in the warehouse? Well, you got worker bees. Okay, are they fixed? Well, they could be fixed. Well, where's the variable? Maybe the electric is the variable, where we don't know exactly. We plug a number. And I think at the end of the day, just in this one example, what happens is as you book transactions, these different costs are accumulated into, overhead applied to material costs. Great. Fixed or variable. So I got a general ledger account that shows how much of that cost is driving in there. And then next to that in the P&L, I've got the actual expenses that are coming in the door. And again, remember my word variance? Now I'm looking at the variance between how much did I absorb, what were the actual costs, and they really kind of validate how good is your standard cost allocation. And in that one, you might say, you know what? I'm within 1%. I'm done. In the end of the day, it's almost like wages, doing standards on wages. How much wages did I absorb? What are my wages? How close is that? But again, there needs to be precision to Mark's point. Otherwise, distorted things. And if you're making decisions based on that, there's the question, how much labor is in my balance sheet inventory? In a 15-level bomb, that's a tough one, isn't it, Mark? How much labor is in inventory? Mm-hmm. How much overhead is sitting in balance sheet inventory? Remember, you took these things off the P&L and you moved them up into your balance sheet. How much is it? $1 million in labor sitting out there, $1 million in overhead? But again, to be able to rationalize those, that's where some of the systems have deficiencies, because as Mark says, it rolls it up into the next level in its material. It almost looks like material costs. Now, some systems will keep a little bit of separation there and visibility, but it may be on the financial side. You may not be able to pull up an item and just see how much is served through it. So anyway, just mention comments.
Yeah, so that's a very interesting comment, and I definitely want to touch on that a little bit. So Chris, and it's just mind-blowing, to be honest, okay? When you look at the whole idea of using tax as a basis for your management accounting. To be honest, and again, if you go back to the theory of accounting, even accounting does not say that you should be doing that. So here, the way you are accounting for your product cost is based on the taxes, okay? In general, you are supposed to be keeping two books, one for your taxes and one for your management accounting, because you are making critical decisions, and that's what accounting framework recommends, okay? Tax should not be the driver for your business. Tax is for the government. It's not to run the business. And I don't know where the wires are crossed here. Why these businesses don't understand. So Chris, over to you. Any other comments?
I think it's still org size. I still think it's ownership structures. Do you got any partners in there? where there's a fiefdom, you got one owner. I allocate overhead based on revenue. So there's an amount of overhead per dollar of revenue. It's easy to allocate it down to the different practice areas. So but again, in different when you have partnerships and you have accountability. So again, the guy that doesn't have to, I'm only material cost. Okay. Like I said, organizationally, but you're correct. It is typically the org size. And as you move upstream, people want accountability. They want consistency. It's just like why the government has cost accounting standards. You have to comply so that we can make assumptions and they're valid, as opposed to we don't know what we have. I use the word distortion. Again, I joke about accrual accounting. It supports distortion if you don't have good compliant processes in place. Small businesses, QuickBooks, it's the Wild West. It's all on Excel. They're booking entries. How much inventory I have? Okay, I'm gonna make an adjustment for cost of goods. There's typically no validation or reconciliation on those at that point. But again, someone's doing a tax return off it. But again, as we grow and we come upstream and there's investors and there's accountability, that's it. And standard costing, again, we want more consistency. Yeah, we want to see variances. We want to be able to manage the business and not be reacting to, well, why, and we have no answers, right? Again, growth, accountability, other stakeholders. I think that's what drives those better practices.
Yeah, amazing insights there. Thank you so much, Chris, for that. Abu, so I'm going to touch on some more comments and then you can offer your commentary on comments that we have discussed so far, and any other KPIs that you might have. So one of the things that I always notice, the way things evolve in the industries, and I think Chris made one comment in the beginning that I always ask my customer, okay, what do you do? Standard, actual. If you are standard, I'll set up standard. Okay, and sometimes that becomes the tradition because everybody's sort of following that. Okay, they have no clue why they are doing standard or actual, and somebody has to challenge them why they are doing this. And most of the companies in the $10 to $25 million space, you are not going to have a CFO or a person who is going to be super seasoned in challenging these things. And it's probably going to be external accounting firm that is driving that, and they are not going to take any sort of legal liability in challenging these assumptions, and they are simply going to inherit, whatever you have. So I think there has to be a point where somebody has to challenge. So I don't know, Abu, whatever you have to share.
Yeah, I mean, we deal with a lot of different manufacturing, like food and beverage manufacturing, chemicals, industrial manufacturing. And what Mark was mentioning earlier, we are seeing maybe one or two clients of ours are using standard cost right now. Everybody has sort of moved towards that, actual cost, right? And actual cost, I understand, it's not like actual, but at least some assumption of actual, right? So direct cost is being allocated to the finished goods, for example, raw material cost, some sort of machine time cost, that sort of data. But the overhead may not be allocated as perfectly to find the actual cost. But, increasingly people want to see the actual cost of the product, right? Whether it's in the chemical industry, where it's more by lot or batch numbers, or even in the food and beverage industry where, traceability is by lot numbers, right? They want to see what's the lot cost or what's the cost of the serial number over there. So, but essentially that's where what I've seen over the last few years, where everyone has moved towards, they're using less and less of standard cost and more of actual cost. Even in organizations which are, perhaps not as sophisticated from an accounting perspective, even they are, sort of moving towards that actual cost model, in my opinion.
Okay, very interesting. So let's touch on one of the questions that we have from the audience, and this is coming from Anders Green, ANDERSGREEN. Follow him, amazing guy. So here the question he's asking, tracking external factors. And for example, international exchange rates, they certainly impact costs, but if we could predict them accurately, we would be millionaires without needing to work. Any comments on what to do with unknown or unknowable is what he had mentioned, I guess, future parameters. So I think I wanted to touch on this one as well. So I'll provide some insight there, and then probably Abu, you can offer more commentary there. So based on Sharon's commentary, typically when you are going to have the exchange rate implication, you are supposed to be recording the impact of exchange rate on a periodic basis, because that's going to be the requirement of IFRS GAAP, because you have to account your asset and liability on the fair market value. And if the exchange rate is going to have impact on your books, then your books are going to be off. That means you are probably reporting off. So technically, you are supposed to be accounting for that impact. But to account for that, you have to have that process. Okay, you have to. I don't know, how the smaller companies are going to do this because they are probably not keeping in multiple currencies, and typically their impact is going to be primarily just from the transactional perspective. But let's say if you're keeping the books in two different countries, then only this particular problem is going to be applicable. So I don't know, Abu, over to you, whatever you have to offer on this.
Yeah, I mean, for sure, you need to have, more advanced systems compared to QuickBooks in order to manage it properly. But what typically happens is even if you're operating in two different countries, you probably have two different legal entities which have their own ledger currencies, right? So that's not as much of an issue. But for example, let's say you're importing raw materials, so you're supposed to record the purchase price. It will be converted into your ledger currency at the exchange rate, right?
Yep.
So if the exchange is 1.3 here in Canada and you receive $100, so you have to, when you're receiving it, the ledger has to convert it, right? So if either you have the system which can do it for you, or you have to reclassify, take that into account at the end of each month or period or whatever. So that's how it will get built into your cost of goods, right? And that's how you'll know either if you're doing standard cost or you're doing actual cost. Is your cost getting out because you're importing significant raw materials from outside the country and the exchange rate is either favorable or unfavorable. There are other aspects to it as well. So, for example, exchange rate also comes a lot in accounts payable reclassification, right? So you have $100. You're here in Canada, you have to pay in US dollars, and the exchange rate has changed, so you have to reclassify every month based on a different exchange, and that's also again true for your receivables, right? When you're selling the product, so and that gets affected on your cost of goods sold. But ultimately, you need to have a system which can track multi-currency, which can track at the transaction level the actual price of the product, right? Whether it's coming in, going out, whatever the transaction happening, your system must be recorded in order to capture that accurate from a costing perspective.
Okay, amazing. Thank you so much, Abu, for that. By the way, and there's just a piece of advice. I mean, don't try the international exchange rate trading. That is called arbitrage trading. You won't be a millionaire. You will be bankrupt. Trust me. You need to know what you are doing. On that note, Mark, I'm actually coming over to you. Any comments over comments? Any other KPIs that you might related to cost accounting?
Well, it's interesting. I mean, we, our whole methodology around managing production revolves around buffering, right? And I'm just thinking, I don't know, maybe Abu has a comment on it, but I imagine you'd want to buffer in some fashion. I mean, ideally with cash in the bank, but buffer in some fashion the variability in exchange rates so that you're covered. Yeah, I think about it sometimes. Our clients in Canada or internationally, I mean, our price is staying the same, but that exchange rate is all over the place. So their cost for our service is changing all the time, in that sense. So yeah, I imagine there's some sort of buffering, hopefully, at these companies' levels, so they can anticipate that in some fashion. Because it certainly is the one thing you do know is it is uncertain and it is variable, so it will change.
Yeah, so very interesting insights there. So I'm going to touch on that comment a little bit more, and then probably if you have any follow-up comments, Mark, you can offer those as well. So when you say buffering, maybe you want to provide some more colors there on the buffering, because typically the way Abu had mentioned, the way companies are going to treat all of the transactions based on the currency revaluation that is happening at the transaction level on a daily basis, they are going to account for that impact on a daily basis. But once your books are accounted in a specific currency in which you are keeping the books, after that you sort of rebalance your books itself. You don't sort of rebalance the transaction in my experience. So tell us a little bit more about, what do you mean by buffering and how would that impact companies?
Sure. Well, I mean, I was just bringing it up in the context of the exchange rates and thinking, do companies, and I'm not even sure if they do or not, but I imagine bigger companies probably attempt to anticipate maybe through forecasts or
Yep.
maybe through standard deviations, anticipate what the variances may be in the exchange rates, and then plan for that in their budgeting primarily, whether short or long. In terms of our buffering, we do that on inventory levels, like in inventory optimization, more in the methodology. We have an optional methodology you can use. It's based on demand-driven MRP. And demand-driven MRP is based on establishing a planning buffer for SKU that you're managing. that looks at not just what you have on hand, but also what's coming in, what you anticipate using during the time it takes for you to get more, whether that's a purchase order or manufacturing, right? And then on make to order or custom manufacturing items, we incorporate time buffers. So in order to protect the due date of your build, right? Because everybody will have a routing, right? So the steps and the estimated times. But the hard part in scheduling that routing is, a backward schedule says let's plan to finish the last operation on the very day it's due. There's no room for variability there. Forward scheduling tends to send stuff out too soon, start it as soon as possible type of thing. So you end up clogging up WIP and having too much WIP out there and slowing things down. So the idea to have a buffer, to have some time protection, so you have a good time to start it, not too early, not too late, but also you're protecting that due date in a make-to-order environment. So that's where I come up with the buffer.
Yeah, great insights there, Mark. And Sharon, I'm going to come over to you, but I'll provide some context here. And I'm sure you are going to have insights in this one as well, because the concept that Mark is talking about, it's in my mind called currency hedging. That's the right term. And typically the way CFOs are going to approach this as, they are looking at the scenario planning for the currency. They are looking for each of the accounts, unrealized gain, unrealized losses. How much did I have last year? What was the currency that impacted that? And then they are going to do the scenario planning, and they are going to estimate, okay, what happens if currency goes up? So they are sort of planning cash based on that, because your cash is going to be impacted, because of this. So, Sharon, over to you. Whatever you may want to share based on this process and any other comments that you might have.
Okay, I think every company has different scenarios. It depends their market and what they're selling, etc. But what the rule of thumb is that it's not like you are accurately predict how the currency will go, but you have to monitor. Does that make sense? Like say, if I use $10 my local currency to buy this cost, the product, and then I can sell $20 that I make $10, right? But at the time, if I spend $10 to buy this product, and then my local currency value decreased, that means if when I turn around to buy another set of inventory, my currency is not enough to buy another set of inventory. Does that make sense? So this is the fact. It's happening, and you can see it if you really monitor the currency exchange up and down. When you see it's coming, you can take action. For example, increase your local selling price, or however adjustment that you possibly can do to make that adjustment so you have enough cash to buy another set of inventory. It is not something like you say, oh, I can predict it, I'm doing nothing about it. It is not how it works. You have to monitor it if that's a very important factor to you. The second thing you can do is that even though you are selling to your local market, but if you buy your stuff in US dollar, you may resell your product in your local market in US dollar. So if it's acceptable with your client, so that the exchange rate factor kind of even out, that doesn't really apply to.
Yeah, no, it does make sense. Thank you so much, Sharon. So I'm going to have one follow-up question. So let's say if you are the cost accountant today, Sharon, okay, you are cost accountant. You are living the life of a cost accountant, okay? Give me 3 KPIs that you will track, and maybe 3 KPIs that you won't track as the cost accountant. You can do 2 if you like, or 1. It doesn't have to be 3.
The KPI I will track is the variance, the accuracy of the sales or revenue projection. And then the second KPI is cost projection. If, compare the variance, that's the KPI that I'm looking at. And then the second one that I would look at the inventory turnover rate.
Yeah.
And then the third one is cash flow is needed.
Okay, amazing. Thank you so much, Sharon, for that. So we have 3 minutes right now. Do you guys have any open comments that you wanted to cover?
I'll give you one on currency.
Yeah, go ahead.
So I've done a lot with currency, and if you go back to the buffer, right? You talk about hedging or what? You're not changing currency. So I have U.S. and I have Mexican pesos. So I have separate cash accounts. I pay in Mexico in Mexican pesos. I don't change my money. So there's a couple strategies there. But if you think about revaluing inventory, and again, when you buy from a vendor, one of the things for the strategy is just buy and sell in U.S. currency. And but it's when you open yourself up and said, all right, I'll buy that from you in Canadian dollars. Ooh, so I'm a U.S. company. I'm U.S. currency. I'm going to issue the PO in Canadian dollars. I've just created the exposure that we're talking about here. Okay, because from the time that I issue that Canadian PO, it's moving. So that's where variability comes in, is when you issue non-U.S. currency. You're a U.S. company, use a non-U.S. currency to transact either a buy or a sell transaction. So if you can do it all in U.S., you're golden. It's the exposure comes when you do it otherwise. And then the hedge is where you agree to a conversion rate. That's almost like a spot buy. Say, all right, we'll do it for this. That's all I'll say. So anyway, it's a good conversation.
Okay, amazing, Chris. So maybe you want to do the closing comment as well. We have 1 minute for people.
Variance. Sharon jumped on it too. You're looking for establish those baselines and look for movement and what's the right way, what's the wrong way. It's that simple. That's macro. Then you drill down. You got to drill down.
That's a 360-degree close, man. You started with variance and closed with variance. Good job. Abu, closing comments.
I'll just brief comment. One thing that's interesting about U.S. customers, they can forget about currency, right? They buy in U.S. and then they sell in U.S., right? It's generally the rest of the world that has to worry about it, right? Yeah. So, but I think in terms of closing, tracking your unit cost, your variability, and how to allocate. I think these are three bread and butter for cost accounting.
Okay, amazing. Thank you so much, Abu. Closing advice, Mark, please.
So I have to disagree with Sharon. I think, yes, you have to have overhead for your taxes and accounting, but you can get rid of it from a management accounting standpoint. And the insight you will have by getting rid of overhead, even labor to a certain degree, and focus on contribution margin, also known as throughput in the TOC world. Pick up a book on throughput accounting and it'll open your eyes to a new perspective.
Love it. Good job, Mark. One disagreement in one show. That's what I like. Thank you so much. Sharon, closing advice, please.
Closing advice. Even if it's not perfect, you still have to do it. There's has to have a method to manage and measure what you're doing. So you have a baseline and variance and know where you're going in the future.
Okay, amazing. Thank you so much, Sharon. So that's it for today. If you joined for the first time, this was part of our digital transformation for which we meet every Thursday at 5:30 p.m. Eastern. So make sure you guys are going to be here next week. We are going to come back with another KPI topic. On that note, thanks everyone for tuning in tonight.
And thanks everybody.
Thanks all.
I cannot thank our guests enough for coming on the show, for sharing their knowledge and journey. I always pick up learnings from our guests, and hopefully you learned something new today. If you want to learn more about Chris Garadini, head over to turnkeytech.com. It's turnkeytec.com. If you want to learn more about Abu Asif, head over to pennymanagement.com. It's PANNIMANAGEMENT.com. If you want to learn more about Sharon Custer, head over to inventoryoptimization.pro. It's INVENTORYOPTIMIZATION.pro. If you want to learn more about Mark Lilly, head over to lilyworks.com. It's LILLYWORKS.com. Links and more information will also be available in the show notes. Also, don't forget to subscribe and spread the word among folks with similar backgrounds. If you have any questions or comments about the show, please review and rate us on your favorite podcasting platform or DM me on any social channels. I'll try my best to respond personally and make sure you get help. Thank you, and I hope to get you on the next episode of the WBS Podcast.
Thank you for listening to another episode of the WBS Podcast. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. For more information on growth strategies for SMBs using ERP and digital transformation, check out our community at WBS.rocks. We'll see you next time.